So, give this a read. How does this address adverse selection from last week? So pre-contract adverse selection, who are we attracting to take this type of deal? Safe drivers, right? So this, you kind of like, oh, screw that, I'm not doing that because I like pedal to the metal. I don't want Big Brother looking at me, you know, whatever. You're not even going to choose this. So automatically, we're kind of overcoming the adverse selection problem by having this in process to people who are raising their hand say, I'll do that deal. That's a safe driver probably, right? That's somebody who already drives that way. They don't have to worry about, whoopsie, kind of pedal to the metal on that one. So that's how it overcomes the adverse selection. How does it address moral hazard post-contract after you get the insurance? Maybe not so much on renewal of the policy. Jason, what were you thinking?
They have less of their pool of funds being drawn out. So basically, they're making a greater, I guess, profit by.
Okay. You're correct that they're saving money with the reduced premiums, if I'm hearing you right. But that's not necessarily specifically addressing the moral hazard issue. So moral hazard deals with behavior. You can kind of remember behavior.
Comparing before they had this to after they received it, their driving habits is similar.
Yes. So what about their driving habits, like
violations or accidents or like bumper to
that's more of the outcome. What I'm wondering is their behavior, regardless of the outcome. Because that's the tricky part. So what you just brought up is relevant. You know, less traffic tickets, less accidents or whatever. But I'm talking about their actual behavior when they're under this program.
They drive more conservatively.
They drive more conservatively. Why?
Because they know that they're being monitored.
That's right. There's a benefit to driving it that way. They know they're being monitored. So if they kind of suspect that, you know, they say that they're monitoring you, but I know the guys at Progressive, they're in those cubicles and they aren't doing crap, man. They're not even looking at there's like 1,000 people. They never look. So don't worry about it, right? So if you started to learn, you guys know that, right? If you start to learn that mom and dad don't really stay up when they say you're supposed to be in at midnight, but they're always crashed by 10 o'clock, right? If you know the monitoring is not there, then your behavior changes a little bit, right? So it starts to allow that decision to be made a little bit differently. So that's all addressing moral hazard issues. If we know that there's a credible policing function of some sort, then we're less likely to do that. If they know that computers, for instance, are sophisticated enough to monitor your driving without a human being monitoring it, and then it sends a little email to some little guy in a cubicle the next day that says, hey, Russ was driving 10 miles over the speed limit between the hours of this and whatever, if the consumer knows that that's how the system works, they're going to be a little more on the straight and narrow. And it's going to curb moral hazard, the fact that we tend to maybe not be as careful once we get that insurance policy in place. Okay? All right, any other comments on that? What do you think? Would you want to sign up for this? Or Peyton, let me hear what
we've had that, and it actually beeps at you at certain situations, so it lets you know.
Really?
Yeah.
Well, you're the first person I've heard had something like this. So you signed up for this.
Actually, my fiance did, and she had it in her car, and every time she would drive reckless, it would go beep, beep, beep.
I don't know. Well, I just got Progressive, and I didn't know I signed up for it. I just got the snapshot.
You just said, whatever's the cheapest, I'll take. And then before you know it, they're monitoring you. You got Big Brother. You're like, wait a second.
You have to plug into your car computer, and then, but mine didn't work, so I had to send it back.
Okay.
I didn't know I signed up for it, so.
But
sending data to them, they're probably going to eventually kick you out
They
that,
email
that
me, say,
plan.
hey, where's your snapshot? You know, why would you plug it in?
Right, right. We know, we're watching. They did this to you. They're like, we're on you. So
That
you're-
might be what I need, because I think in the last 6 months, I've gone out of 5, 6 speeding tickets. Luckily, which I don't know how many more times I can get lucky with that. Especially
5
since
or
my car is.
Well, that
I
see,
have the Tennessee ID, and my car is still my old one was still registered in Tennessee. So I think they kind of gave me some lenience whenever I got pulled over a couple of times. 'Cause I don't know where I'm at. I grew up here.
well, yeah. So that's an interesting thing. Some people will volunteer to constrain themselves that way. That hey, I want to be monitored because I don't want to get a ticket, but sometimes I'm just absent-minded. Not you specifically, but I would prefer for a little beeping sound and have that incentive. So yeah, some people might take them up on that offer for that reason.
All the rentals at the enterprise that they make us rent for recruiting, they all have it. And
Do they really?
They also.
Oh, they do?
Not only do they vibrate if you're tailing too close, or like if you're changing lanes like too close, it'll vibrate and it'll tell you to slow down or whatever.
I never noticed it either.
And then the next morning, like I got back to the car,
The steering wheel vibrates?
the seat, the whole
Oh,
car, like it vibrates and it beeps and it says slow down. It says your speed limit.
Through Enterprise?
I
I
haven't
never had one of
done
those.
That's because you got to be going 20 miles over the speed limit. I've never personally taken one that
I
high.
was only going like 8 because I was trying to pass a semi.
It's probably not even an insurance thing. You're just pushing that car to its limits. And it's like, listen, I can't go in.
I've never done that.
It tells you an alert the next morning too. It says like 3 times you were 8 over the speed limit. You should monitor.
Oh, really?
Yeah, it gives you a little when it turns on the car and it's like hello Chrysler or whatever. It says the alert's the first thing that comes up. So it's the first thing.
Well,
you see.
maybe I am a good driver.
No, I have not. I have not heard about that. All right, so we just kind of went over some examples, hidden actions. So we'll move on to the next thing here. Let's go to the bike example we did last week. So bike owners stand a 40% chance of theft when parking their bike on a street overnight. However, if the bike owner exercises care, i.e. locks the bike, the chance of theft is reduced to 30%. Suppose the cost of taking care, buying a lock, is $5. What is the marginal benefit and marginal cost of exercising care? So why don't you get your piece of paper out and start scribbling some stuff down. So we still have the parameters are the same we did last week. $100 bike, remember? And we're in the 40%. What did we call our person again? Was it Bob or? Remember we had Rachel and
Bob.
did I say Bob? Okay, so Bob was our higher probability guy. So apparently we're dealing with Bob here. You got 2 states of nature to kind of consider here. So you got the 40% chance, which is the status quo, and we've got the ability to buy a lock for $5, which will reduce our probability down to 30%. Is it worth it for us to do that? that what you came up with? Were you thinking along those lines? Once you kind of see it, we improved our chances by 10%, right? So we had a 10% chance of, instead of incurring the loss, if we calculated out our expected value, we just have an expected benefit now of using the lock of $10. We've reduced our exposure in expected value terms. And if you work that out separately, we had a 40% chance of a loss. If you kind of do the step that would be before that math step there, we've got a 40% chance of a loss of losing what? $100. What does that cost me? 40 bucks. If I can reduce it to 30% chance, I have an expected loss of 30, so I'm saving $10. Right? That's the $10 benefit. So the benefit's 10 and is greater than the cost of exercising care. The bike lock runs me 5. So what does the uninsured person do? Do they buy a lock or not?
If the benefit outweighs
Yeah.
the cost.
Yep. As long as the marginal benefit is greater than the marginal cost, do it. If not, don't. That's kind of our rational response to that. So our next thing looks at, well, what should State Farm expect? So the cost of theft is reduced when an insurance policy is purchased. Right? That's the whole reason we bought it in the first place. Will the consumer take the extra time to lock up the bike every night once she buys the insurance? Not as careful, right? So that's where this moral hazard part's coming in, is that once we buy insurance, what is our expected benefit of locking up with full insurance?
If you buy insurance, it should be covered.
So there's a harm.
Yeah, so what's your expected benefit of locking? Nothing, that's right, it's 0. What's your expected cost?
What was it?
Or your actual cost, whatever.
The bike.
$5. No, not the bike, the lock. So we're kind of down to this lock issue. So again, the rational person that the economists think these people are, do I lock up or not? A lock cost me $5. The expected benefit is 0. The costs are greater than the benefit. Screw it. I'm not locking up. Right? See how we've changed things by the insurance. And so State Farm, the insurance company, would be foolish to think that, hey, if we just give, if we just tell people, hey, that, you should lock up, it'd be a good thing, they just might not do it. So the insurance companies have learned to anticipate moral hazard as well as adverse selection, and so they changed their business practices accordingly to think about moral hazard. Now, maybe there's profitable opportunity here. How can the insurance company induce the bike owner to exercise care? Is there something State Farm could do to induce the people to still lock up even after they have bought insurance?
That'd be like leaving my keys in my car. If my car gets stolen, my keys were in there.
Okay.
I'm gonna get. It's different than if my keys had not been in my car.
Okay. So good, but let's stick to the bike example. How does it relate to the bike? But you're right, that type of thing. How can we tie this to the bike example?
Making them responsible for locking up their bike as well, and if they didn't.
Yeah, but how? How are we going to put their feet to the fire? Because Peyton? You look like you're stewing on something here.
I don't know if it's right, but I'm thinking, some type of reward or some type of motivation to do that.
How are you going to track it? How are you going to, the problem is, how is State Farm going to know if they were doing their end of the bargain by exercising care? In this case, exercising care remembers the lock.
Give them the lock that they can track.
Okay, a trackable lock, maybe.
Or-
Although if it's on the bike, we don't know if it's actually attached to anything.
Or a reward, like if your bike isn't stolen and for so long, there's no issues in 2 days, then
Okay.
lower a premium. or
Yeah, so
something.
they might be able to have some sort of history. That might be a possibility. Anything else? With the lock example.
Give them a free lock.
Yeah, is the free lock going to do it though? We need them to actually use the free lock is the problem. So if there's an event, how can we show whether they exercised care or not and they had a lock? Show them the broken chain? Right? I mean, at the lock, I mean, that's one, basically, it could be something along the lines of, we're not paying for your bike if you don't show us a broken lock. You agreed to exercise care with the lock, or that's not even totally fair. Hey, I forgot one time, I've locked it every night for the last 100 days, and the one night that I didn't lock it. And then if that's the policy, well, we said it clearly in your policy that you had to lock it, I'm sorry. That could start to create bad customer service or bad blood, and maybe people don't want to deal with that. Oh, everybody makes mistakes.
Well, then you could leave the lock at home, if it gets stolen, just smash it and take a picture.
That's true too. You're right. Yeah, you could, and there might be ways around that. So, not an easy thing to deal with. Like you say, the tracking thing, or maybe if there's some sophisticated technology similar to our bike thing. All right. So yes. All right. So here we go. Give a moral hazard and adverse selection explanation for each of the following. Drivers with airbags are more likely to get into traffic accidents. Drivers with airbags are more likely to get into traffic accidents.
Or just talk out loud. Or just-
So relate this to moral hazard and adverse selection. So let's just start with moral hazard.
Well, they know they have airbags, they can run.
They feel safe.
Okay, so they drive more, they feel more safe and they drive more recklessly. And adverse selection.
Well, the airbags are deploying, that's how they can track.
No, think pre-contract. And now you got to kind of, well, what do you mean by the contract?
They thought that they were a safe driver.
Okay, Peyton? It's not so much that they thought they were a safe driver. So the adverse selection thing, pre-contract.
More hazardous drivers are more likely to pay for airbags.
Good, right? So who's buying the airbag cars? People who are more reckless. They're like, oh, I'll just buy one of those cars with an airbag, right? So then that's the adverse selection argument. So this is just kind of trying to clarify that kind of strange gray area sometimes. And again, it's always helpful to think pre-contract, post-contract. Before the fact, who's going to be buying those airbags? Volvo drivers are more likely to run stop signs. So I always give a little bit of history here because it's not always as obvious. But in the old days, for sure, Volvo was known as the highest, safest car. They were made out of 10-gauge steel that would be darn near impossible to crunch. So Volvo drivers are more likely to run stop signs. Moral hazard. Feel safer, similar to the airbag thing. Okay?
I'm in a tank, I can run.
I'm in a tank, I can go, right. So kind of similar in this one to the one before. All you can eat restaurants. Customers tend to eat more food. Can you guys relate to that? All you can eat restaurants, do you tend to eat more food there? Okay. Moral hazard, adverse selection. Yeah, adverse selection, people that eat. All right, so if you're opening up a restaurant and you look at data and you say, wow, the average person consumes 1 pound of food per meal or whatever. Let's just use weight as an example. And so you're like, I got an idea. Let's have a buffet, and we should end up having our food cost be approximately 1 pound times 300 customers coming through the door. We're going to serve 300 pounds of food, right? They open up the restaurant and they attract people who tend to eat 2 pounds of food. The 1 pound, the half a pound people, do they come to that restaurant? No, right? So, not thinking that the data said the average person, but adverse selection tells us that you're going to be attracting big eaters to the buffet. And then, of course, the moral hazard aspect is what? They eat more. Whether you're the half-pound eater or whether you're the 2 pound eater or the 1 pound eater, if you're there post-contract, what does post-contract mean in this context? After you're there, you paid your ticket in, right? So you paid the $7.99 or the $9.99 or the $12.99 or whatever. You paid your entry fee. Now you're sitting there and you're like, well, geez, it'd be kind of a waste of money if I didn't go up to the buffet line again and grab another helping of that stuff. It's free. And so from a cost-benefit analysis, you're right. Because at a regular restaurant, if you wanted another helping of something, you're going to have to cut out a check for another $5. But now what's the cost? Be careful, I'm trying to trick you a little bit. What's the cost when you're at the restaurant of going up and eating more?
$7.99 whatever you paid prior.
Nope, I'm not hearing the right answer. I need you to think outside the box. This is economics class. This is not accounting class. This is economics class. What's your cost when you're sitting at the restaurant? You've paid your thing. You've eaten your one meal. What's your cost? I'll give you a hint. That's your hint.
Transportation.
Getting out of your seat. I'm serious. That's a cost that you need to consider. What are some of the non-monetary costs that are involved with the decision? One of those is the effort of going and serving yourself, which you don't do, remember, when you go to a sit-down restaurant. They bring the food to you. So you still have a cost of spending more time there, perhaps, is another argument that you could go, but actually having to get up, go over there, think through. By the way, that cost is real low, but in my eyes, as an economist, there's still a cost associated with that. And we actually see this. I'll tell you one shocking example of this. In fact, do I have the, let me see if I have the thing on this. This is really cool. I bet I won't be able to find it timely enough, but let's see. There's the odds of dying. There's Somalia and anarchy. That's a good one too. Let's see. Where's my miscellaneous? I'm going to give up on this in a second. Where do I have that? I know I got it on one spot, but I'm not going to take the time to get back to that. All right, so I'm going to just, this is something I can tell you, but it's I had a picture of the actual thing. So in an economist did a study, this might have even been a combination of psychology, I can't remember for sure it was an economist, but Austria and Germany, two countries that are pretty close to each other, similar in culture in a sense, you know, they're both over in Europe, whatever. And they said on their driver's license application, do you, or please check box if you want to donate your organs if you die. And so there's a little check box here. Okay? And then in the other country, they had please check box if don't want to donate. Okay? That was the two differences in the study. Here, check the box if you want to donate. Here, check the box if you don't want to donate. So what they found is that in this country, 80% of the people, let me think, I gotta go the right direction with this, because this has huge social implications. In either case, people had to do this or this, right? And so the results were that 90, this is where I wish I had my slide because I'm kind of trying to make this up a little bit. I think it was 98% of the people said to, this is my problem with doing this on the fly. Let's see, don't donate. Yeah, right. Don't donate, right. So this means that they donated, right? So if they died, they had to give up their organs. Correct?
They didn't check the box.
Right, if they didn't check the box. So by checking, that means they didn't want to donate, right? Okay. So what they found was that they had 98% donors in this country, meaning most people didn't check that box. And in this country, they only had 20%. Why? Because here you had to check a box, here you didn't. And so the effort, the cost associated with checking the box led to this social outcome.
Wow.
Isn't that amazing? So that's what I mean by the cost. Sometimes you got to take this really seriously and not forget about the cost associated with thinking, oh, I don't want to think about it. Oh, I hate these forms. Oh, I don't want to even read this. I'll just sign my name at the bottom. So if you left it unchecked, that was the response. And so we just saved a bunch of lives here, right? I mean, if we're donating organs at the time that you're dead, and you're dead anyway, so, you know, some people are funny about that for maybe religious reasons or otherwise, but you just saved a whole bunch of lives in this country relative to this country just by the way you framed the form. So this stuff can be powerful that way. Yeah. So and that gets into a little bit of the behavioral economics stuff on how you frame the question and whatnot. Okay, so oops. So we did our all-you-can-eat restaurants. Shirking. So, what is meant by shirking? What's a shirk? If somebody's shirking, that's a kind of econ lingo. What are they doing?
Charging more than what they
Kind of. Yeah, they are charging. They're charging kind of more by slacking. So shirking is kind of slacking off. You guys have seen that. Maybe some of you have done it yourself, right? We've all done it to some degree where you're, for whatever reason that day, you might not be every day, but on some day you're just like, screw this. Let's just talk for a while. Let's have fun. That work can wait till tomorrow. All right, so that's what shirking is. And are there solutions to this problem? Commission, okay? So tying it to some sort of end bonus or something, okay? So that might be one way we can start to help alleviate that. But if it's pure timing, like if it's not time sensitive, then whether the project gets done on August 15th or August 22nd might not matter to the bonus situation. You're still going to get your bonus either way as long as it gets done. So what else could we do to avoid the slacking off? How could we structure the pay differently than the hourly pay?
Deadlines?
Deadlines, yes. So we could have some tight timelines that we both agree to up front, but that would be kind of like, well, okay, so if we did it in the strictest form, give me an example of how that would work with deadlines. So we agree to an hourly rate of $100 an hour for some consultant. How would you articulate that in a contract?
You meet the deadline, you get a certain.
Let's stay away from the bonus thing.
You would be working on the amount that you were agreeing to in the beginning. You're working towards a certain number. So I want to make $100 on this project, which is it's going to be $10 an hour or whatever. So I have
Right.
10 hours to do this project
Yeah.
in order to make my 100.
All right, so we're essentially, and why I wanted you to work through that is that it can be set up so that it's not much different than just a flat rate contract, right? I'll do this job for $1,000, or I'll do this job for $100 an hour, not to exceed 10 hours of work, right? Now that's a little different. How is that different? Those two things. Let me just throw that out to you. I'll do the job for $1,000, or I'll do the job for $100 an hour, but not to exceed a maximum guarantee, not to exceed 10 hours. You got the potential is there for the benefit to go to the person engaging in the contract, right? That if it only took 5 hours, then you're only going to charge me $500. So that's beneficial. On the flip side, if the people are honest and it actually took 12 hours, then it worked to the benefit of the other person, right? And so if they max out, that's usually the story that they'll say is, I knew it was going to come back at 10 hours, of course, because that was to your benefit to have it then. And then you'll get a little song and dance, which hopefully is right if you're dealing with trustworthy people, that says something along the lines, yeah, I'm sorry, this job took way more. I mean, I honestly, if I think back, I probably have 16 hours into this project. You got a deal, right? That'll be the song and dance that you hear, whether that's true, or maybe they really did spend 16 hours, but half of it was on the Xbox, shirking, right? So they were kind of, how hard did you work during those 10 hours, those 16 hours? Nobody knows, right? So at the end of the day, we can kind of overcome that by having some fixed payment contracts so that you know, hey, I agreed to that. If it works out to be less, great, that's good for you. Otherwise, I'll just expect the maximum charge.
If you maybe, if you make a certain amount, if after you work, you make more money, so that way another way of preventing it. Like, some of our players work at the Coleman warehouse, depending on your speed, determines how much you make it out.
Oh, yeah, no, that's great if you can do that. Not all positions you can do that,
Right,
but you're right. Yeah, if you are more productive, you get paid more. You're paid on your productivity. In the economist world, that's perfect, yeah. But we don't always have the ability to monitor that productivity in that way. But yeah, you're right.
That would be awesome.
Like a manufacturing job.
Yeah.
Or another thing was my wife used to work at a grocery store. This was years ago. The number of beeps, beep, beep, beep. They monitored the number of times you were scanning items. And so in her case, I think they did that more for like quotas, that if you want to keep your job or if you want to get a raise. So raises were dependent on how productive you were with the number of beeps that went by.
That way PT and ADS where I work, like you have to have your numbers have to be at a certain point before you get looked at.
Right. For advances or promotions or raises, yeah. Okay, so financial sector. Okay, so there's this saying in the banking world that you want to have people with skin in the game. How much skin do you got in the game is the mantra that you'll hear, especially post-financial crisis, because prior to 2008, there was other factors that they thought made the deal invincible, that real estate prices were always going up. So the fact that McCullough didn't have much skin in the game, that he was able to buy $500,000 property, leveraging $480,000 into it, putting $20,000 down on a $500,000 purchase, well, that's not so bad. And I'm just making up numbers, by the way. That's not a real deal, although it might not be too far off some of the deals that we did. So how much actual money of your own money do you have in the game? Kind of helps with the moral hazard aspect of it. So when you start using other people's money, then people tend to get a little more riskier. Oh, it doesn't, it's not my money. Ultimately, if things break down. So that's the balancing act. Now, what happens in the financial sector that's been going on since the beginning of borrowing money is that there tends to be a pendulum that's swinging. And so if you want more business for your bank, and we're already at a point where all the, let's just say the good people or the less risky people, the people that are really solid already have loans, then one way that you can attract more business to your bank in terms of loans is to start taking on a little bit more people on the fringes, right? Well, I'd like to do this deal, but I only got 10% down. Or I'd like to do this deal, but I only got 5% down. And so as the economy starts to look good and they think they've diversified their portfolio and they've got lots of people, they start to take on more and more of those sorts of loans. If the economy's moving real sweetly in one direction, in a positive direction, they start to make more and more of those loans. And before you know it, we might start to create some sort of price bubble, and that bubble eventually pops, and then people are losing money. They never would have guessed that would have affected this many people. They lose money, we contract, and now we're more tight on lending standards. And so the seasoned veterans out there that have been around in the 80s, there was kind of lending type crisis, and then we went through this long expansionary period. So that cycle tends to persist. And one of the things that I've come to observe of why is that you always have the old farts who are tried and true that actually know that cycle, and they're the wise ones that say, oh, we don't want to loan that guy money because that person's a little too risky. Then there's the young buck vice president that's been lending now for 5 years, and they're like, oh, they've never experienced the pain of the bad times. And eventually you get distant enough from the bad times that even the old farts start to say, well, you're right, maybe things are different now. Maybe due to technology and computers, we're just smarter than we were before, and that won't happen. And so the old farts start to soften, the young bucks are still as aggressive as they always were, and we start to take on more and more riskier loans. And so that cycle tends to happen through the churning process of real human beings being put into these positions of making decisions on loans. It's kind of my spin on the financial industry. Any comments or questions there? All right, so give this a read first before I yabber. So have you guys heard the too big to fail quote? Right?
Oh, yeah.
In the last class too? Which one, well, what was that? Or what was the issue that you talked about?
When they didn't let them so they had government backing and
Yeah.
they didn't get to this, they would have crashed.
Oh, so you actually watched a little
They watched the whole video.
video on it?
No.
Yeah. So, I mean, that all deals with moral hazard and adverse selection in a sense. So, who are we going to attract in terms of an adverse selection? Oh, the banking industry looks like a good place to be. The government always bails you out. So I attract possibly riskier entrepreneurs, if you will, that might go into other industries if they didn't think that there was some honeypot deal with banking. And then you've got, once they are a bank, they can continue to take more risky and riskier loans an interesting book that I go over in some of my money and banking classes is the Financial Crisis and the Free Market Cure, written by John Allison, who gives this awesome insight into the banking industry because he was the CEO of BB&T. It's a bank we don't really have around here, but it was right up there in the top 10 of U.S. banks with U.S. Bank and Chase and Bank of America. So BB&T was a big player and was affected by this. And he kind of more or less blew the whistle on some of the stuff that he saw going on that set up lots of moral hazard issues along the way for the banks that were kind of inside, and how detrimental that can be. And one of the stories that he told was how through FDIC insurance, do you guys know what that is? FDIC insurance, you've heard of it. What does it mean? I won't ask for details from you, but FDIC insurance. So you put your money in a bank, and if it's an FDIC insured bank, which all banks are, by the way, what does it mean? Nobody?
Does it mean that the government will back up everything that you have in there?
Yes, for the individual. So if you put in $10,000 of your hard-earned money and that bank goes under, the government will cover your $10,000 bucks. So up to $250,000, there's a max, but any money that you have in that bank is technically insured by FDIC insurance, which is the bank.
Is that per individual account or total?
Total at that lending institution. So you can have $250 at Chase, $250 at Bank of America, $250. So if you're a millionaire, you can park that $250 in 4 different places, and you'll be okay. So it is at each account at a different institution.
Multiple accounts with that same bank.
Right. Then it's the sum total of the amount you had in there. So you can't just open up new accounts.
Got it.
So that sounds great for the consumer, but moral hazard, adverse selection type arguments there, the consumer has no incentive to make sure that the place where they're putting their hard-earned money is a solid, sound bank that makes good loans, right? So we don't do any of our own research. Imagine if it was a totally free market. You would be Googling and checking customer reviews on how good of a bank this bank really is. Is this bank making good, solid loans? Are they transparent? How is their star rating? Imagine if we had a star rating for banks on their credibility. But all of a sudden, you guys would be pretty careful with where you put your money if you knew it was in jeopardy if that bank goes under because they're making bad loans to the public. So that's the market discipline that's brought about from a free market, a market that doesn't have the government saying, oh, I'm going to bail you out if that bank goes under. I got you covered. Right? So that creates this moral hazard, or that takes away some of the market discipline that we would have in a free market, is the consumer being the watchdog. So we did the buyer beware, the consumer beware. You do your research, you'd be a little more careful with where you put your money. So that's one aspect of it. So a new bank starts up, right? A new bank starts up, and if their savings rates, let's say the going rate, if you will, the market rate is 5%. Back in the glory days, it's long from that now, but 5% on a certificate of deposit or a savings account or something. And that's kind of the going rate. And then Bank ABC that just started up comes into the market and they say, hey, we'll give 7%, right? So now they're attracting people to their bank, possibly taking some people away from those existing banks, but otherwise just getting new business to the bank. Because somebody who's new to the market, they're like, oh, well, this one pays 5%, this one pays 7%, let's go where the 7 is. Why? Because I don't have to worry about the riskiness of the bank because the government's got my back, right, with FDIC insurance. So I go over to that bank. That new startup bank is able to attract a lot of funds in terms of deposits. The banking business is that they will loan out that money, right? They don't keep the money in a big vault. Of course, they're loaning it out to cars and houses and businesses and real estate developers and all of that stuff. So they're making those sorts of loans. But if they're paying 7%, they need to get a higher than that rate of return on their loans. Who's going to be willing to pay higher rates for their loans? Risky people or super solid safe people? People who can't get a loan anywhere else, or the risky people, right? So now all of a sudden we start attracting risky loans to this new bank because they had it. So they got the ability to raise capital fairly quickly due to the government involvement through FDIC insurance, among other things, but that would be one driving factor there. And then in order to make loans, they can't compete with Wells Fargo and Chase and some of the other big local banks that have been established for 40 years in a small town. Everybody goes to them. They're rock solid. They've been there. That's where I got my money, blah, 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 blah. So when they get turned down at the rock solid bank, they go to the new bank in town. Hey, I heard you guys are looking to do some loans. Well, I've got this crazy idea. What do you think? Well, we need 12%. 12%? 13, 15%? I don't care. Doesn't matter. I'm going to make $1 million. This thing, screw that. That's easy, right? And so you start attracting the risky loans. Of course, inevitably, not all of those loans make it. Worse yet, if there's a real economic downturn and loans start to go, those people drop harder than the solid people that are at the other banks. The bank fails. The depositors still get their money because they were bailed out by the government, right? And so that creates kind of a not so good outcome in the banking industry due to the government's involvement in that industry with the safety mechanisms, which all have great spins to it, right? As far as the safety net, oh, we'll protect your investment, and we'll say, that all has a nice spin to it, but from an economist perspective has some nasty consequences in the form of adverse selection and moral hazard.
You prefer a free market then?
In general, I like to implement free market principles where it's possible, and so this guy's answer to that would be, we don't need the government to have FDIC insurance. We could self-insure ourselves. So banks could be all members of their own organization, and here's how this would differ. This is getting too technical than I should be going into, but yeah, if you guys are digging the story, it's really interesting. The premiums that the bank pays for FDIC insurance are more uniform across the board. So the risky bank is paying the same FDIC insurance as the solid bank. What should the risky bank be paying for in terms of premium? Higher, right? Just like if you're the risky driver and you've gotten into 5 accidents and 45 tickets, your insurance rates are way higher. So if they were self-policed with their own consortium, then those premium rates would reflect the fact that they're doing it. Now what we've done is that the risky bank pays higher premiums, therefore incurring a higher cost. Now they have incentive to not give a loan to Joe Blow, who's going to go under, because that's going to either make their premiums go on top of maybe making their... You see how we've equalized things by having the premium dollars reflect the riskiness. And all of the member banks have incentive to have a monitoring mechanism to make sure that each bank in there is not getting too risky, right? Because then that's going to be bad for the overall industry. So the bottom line is, not in all cases, but in some cases, we might be able to set up self-policing voluntary efforts among the private agents rather than having big government say, oh, I got the fix for it, and I'll just run this or monitor it or regulate it. A lot of industries have the potential to be self-regulated. By the way, with stuff like that, they have to be transparent so that the consumer can see that, oh, I'm a member of this group, so that we don't have that, oh, it's just a bunch of big banks that are all getting rich off of us. And what's worse is what the reality is today is that the big banks are in bed with big government, making all the rules and the regulations and doing it all to their interest so that it becomes more and more concentrated. The number of banks in 1929, like pre-Great Depression, and this actually persisted for a while, but it was like 46,000 banks across the United States, or maybe it was 36,000, I can't remember exactly. we're down to like 6,000 banks now. And in 2008, prior to the financial crisis, we had like 10,000 banks. So even between 2008 and today, there's been a pretty dramatic reduction in the number of banks that are out there. So from the economist's perspective, less banks, less competition, less benefit to the consumers potentially. So, all right, any other comments or questions there?
That's interesting.
So,
You should pitch that.
Well, it's pitched in this book. A lot of what I just said was what John Allison did in his book. And I'll be happy to share the book. It was The Financial Crisis and the Free Market Cure. It's a pretty layman's read about the whole financial crisis and the problems, but a lot of it brings up these principles. And so why it's important for this class, why I like to give you that little story is maybe twofold. One is to be cautious about policies that a company has, policies that the government has, that are out there that might create distorted incentives for the outcomes that you're trying to get. So as an MBA student, when you go out into the real world and whatever you're applying it to, you want to think about how those principles might be distorting the behavior and therefore the outcomes that you're trying to reach as you set up a new process for your company that involves work teams, for instance, or some other thing of changing the company around. Because all of that, whether we're talking at the government level or the company level, the basic principles of adverse selection and moral hazard apply, whether you're thinking of your customers, your employees, or other stakeholders, your shareholders, board of trustees, anybody.
Why don't they do that? I mean, it seems like a more logical solution than diluting the value of your dollar,
Why don't they do what? A free market solution,
Yeah.
you mean? That gets into the existing status quo is a bunch of people who already are in power, and in order to get change, they would have to vote themselves out of office, vote themselves out of a job in some cases. So our system's kind of fundamentally flawed that way. Until there's a grassroots effort, God bless America, if we can get the word out to good young people like yourselves, and you start to see a candidate that talks that way and hopefully isn't yet corrupted by the system themselves, because a lot of times politicians, of course, talk a good game, and then once they're in office, they're in the system now, and then it's self-defeating for them to get reelected if they put a wrench in the system. So it takes a real special, I think that's some of the attraction to Trump. And by the way, I'm not even a Trump supporter 100% by any stretch, but I think that's what he's bringing to the table, is people are kind of tired of the institutional politician that doesn't seem to get anything done and we don't see changes. So somebody who comes in and that's not attached monetarily to the system through lobbying efforts and otherwise, that's speaking to people, that's resonating. And that's why Trump's doing pretty well, I think, at this point in the polls. And whether that'll persist or not, who knows? I don't know.
This is self-funded. I mean, I guess
I'm not a political science person,
it's
so.
hard to go against, your funding, your sponsors. It's hard to, if those are your values.
Right, oh yeah, for sure. Yeah, and people, politicians end up making real deals and all of that. How do bailouts end up hurting responsible borrowers? So we got a bank, we've got a pool of borrowers, we've got irresponsible people, we've got responsible people. How do bailouts end up hurting responsible borrowers? Yeah, increased interest. Those costs have to be paid somewhere is the point of that. And so the Obamacare with health insurance was kind of similar. That wasn't quite the same way. But as we bring on people who don't care about their bodies and partake in risky activities and they end up having extra health insurance type issues, that raises the premiums. Responsible people end up paying the freight, right? So if they're bailed out in that context, if they're bailed out because they're still going to be covered whether they smoke, drink, and are overweight or not. Then the responsible people end up paying for part of that anyway through higher premiums, even if they do get some benefit with that. All right. So I am going to work through the next chapter 2. I know it's getting a little late. I guess if you guys are busting at the seams, it's fairly short. And then I thought we'd take a break. Maybe we should just take a break. Let's take a break. 7:30.
It'd be a quick one.
I was going to say, yeah, we should take a break. Every time I say that, I'm like, no, that's not a good idea. Let's just take a break.